Welcome to episode 25 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. In honor of 25 episodes, today's is not an interview with an independent sponsor. Instead, we're going to pull back the curtain on Minds Capital itself and have a conversation, the three of us, about how things are going with the fund, everything we've learned, where we're headed. We do a quarterly call with our LPs that shares a lot of this sort of behind-the-scenes information. It's always very well received. So we thought we would do something similar for a broader audience. To kick us off, Nicholas, why don't we level set with a snapshot of where things stand right now, August 2025, with Minds Capital Fund 1?
Fund 1, our goal was to invest in 20 deals and back 20 searchers or independent sponsors. So far, we have closed 13 deals after, 15 or 16 months. We have another 2 that we have committed to that we're waiting to close. 3 as of earlier today. And then we have 5 that are sitting in partner review right now within our pipeline, of which several of those I would expect we will approve. We are just still evaluating them. So our goal was to deploy this at a cadence of about 1 deal per month. So far that is going pretty well. As far as what we are investing in, it's skewed more towards independent sponsors than searchers. We've simply seen more deal volume from sponsors. It's a bigger ecosystem. And then in terms of valuations and data, I think our average deal right now, let me just look it up. If you take the ones we have committed to so far, I think we're sitting at around 5 times EBITDA or just below. And the EBITDA of these companies is sitting at about 3.8 million of average. So that's what our portfolio looks like to date. And anecdotally, it feels like our deal flow is only getting better. And the 3 of us are obsessed with deal flow because, as we always say, that's where the value comes from for us. And the more deal flow we can generate, the better returns we should be able to generate because we can be more selective and also learn more.
Thank you for that, Nicholas. Let's actually double click on something you said there about the blend we have of deals we've invested in that are either independent sponsor versus searchers. When we launched, we thought that we would invest in a lot more search deals than we have, probably the majority. And in fact, it's been just the opposite. And that happened pretty quickly when we looked at the ecosystems, the deal flow that we were seeing. We are easily 90% invested in independent sponsor deals and don't expect that number to go down. Let's say more about that discovery, really, that we were going to be pretty much an independent sponsor first fund. Max, maybe add a little color to this too, because at LCS, at your firm, you also work with both sponsors and searchers. So you have, kind of that stream of work to understand the differences between these two ecosystems and deal opportunities as well.
Yeah, it's been an interesting evolution. And initially I did think, and this is going back a couple years ago, I thought we, as a fund or even before Minds Capital was conceived, I thought that I would be investing in a lot more self-funded search deals. I think the biggest preclusion for Minds Capital is the fact that we really can't invest in self-funded search deals anymore that are funded with an SBA 7A loan because we've got some LPs that are not U.S. residents. So the SBA deals now, the self-funded search deals, none of the LPs, in our understanding, can be non-U.S. residents. So the first easiest answer is we simply just can't invest in those deals anymore. Another issue with those deals for us is just the size of the deals tend to be a bit smaller, and we're trying to deploy a relatively significant amount of capital across a portfolio, and there's just not enough equity available in those deals for us to deploy the amount of capital that we need to deploy. Anecdotally, I think just personally, the self-funded deals, the self-funded searcher is at the end of the day, it's an entrepreneur who's looking to acquire a business. In many cases, they have a long-term hold mindset as well. Sometimes that doesn't align as well with institutional capital. It's not that those deals are not investable. It's just that searchers are often not professional investors that are seeking to have, a real strong investor relations department, strong financial reporting and everything that goes along with reporting to institutional investors. Independent sponsors tend to just be a little more geared towards raising equity and deploying that equity and then reporting and providing all the required investor relations that go along with that. So, we're relying on our sponsors to provide that information for us so that we can track performance, that we can report back to our limited partners.
Max, I think you said something really good there about independent sponsors are raising capital as part of their business model. They have a capital raising motion that is baked into their very process. And self-funded searchers don't. Many of them are raising capital for their first and perhaps only time. The other thing that's really kind of emerged for me is the profile of the kind of mentality of an independent sponsor versus a self-funded searcher. And independent sponsors are doing independent sponsorship, kind of entrepreneurial private equity as a career and a career path. They're going to do multiple deals, and if you kind of press them on what they saw themselves as, it would probably be investor or active investor managing a portfolio. Whereas if you pressed a self-funded searcher, I think many of them would see themselves as owners of their businesses. So it's kind of an owner versus investor mentality. And there's a big difference in how those two groups, those two mentalities approach their own capital providers.
No doubt.
And it's almost like the self-funded searchers with an ownership mentality are raising equity from investors. It's almost as a necessity because they don't have the equity themselves. It's something that we've talked about. We were just talking about offline. And so it's not something they run towards. It's almost a necessary evil to get their deal done, which is how you would expect an owner to think that, if they see themselves as owners, they want to own as much as possible. Perfectly natural. But if you are a capital provider into these two groups, it feels slightly more hospitable, though the investor type whose very business model is taking your capital, growing it, and returning it to you. That's what they're in business to do. The self-funded searcher or owner mentality, much less so. The capital raising is a means to an end for them.
Yeah, that's a great point, and that's a huge distinction between the two. And it kind of just, it is what it is, right? I mean, you've got one group that's, like you said, they're looking to acquire their first business. They may hold it forever. For the most part, their dream as of today is to acquire that business, be their own boss, run it. It's a great dream, and it's why that model is so popular, and there's a huge demand and need for it in America. You've got so many small businesses that don't have a succession plan. You've got the silver tsunami that's been happening, and it's ongoing. We need these good buyers that are willing to take a risk to come in and steward these businesses, on to the next generation. Whereas the sponsors, the independent sponsors, like you said, they're deal by deal private equity professionals. They're doing this for a career. We are hoping to do more than one deal with you if you are an independent sponsor. We want your next deal in a couple of years or next year or in some cases in a few months. So we're looking to build relationships. We're looking for a pipeline of deal flow. We're looking for sponsors that we can build trust with. And I think, search funds tend to be more of a one-off, make the acquisition, run the business, and perhaps another deal at some point in the but perhaps not.
There's a flywheel effect in being a capital provider. I now see that where you do all sorts of diligence into, of course, a deal, but also the sponsor of that deal. And once you've diligenced the sponsor and worked with them and see how they performed in that deal, there's scale in just working with that sponsor again, because you have that much more comfort and confidence in what they're able to perform. And so this concept, Max, that you mentioned of kind of repeat business and working with sponsors who are doing multiple deals, and so being along for their ride, deal after deal after deal, project after project, is where we start to see some of our own kind of kind of flywheel start to turn. And of course, every business wants a flywheel, and that's part of ours. So it's and that's something that would be all but absent in if we were just investing in Searchland.
I do want to inject here and say that among all institutional investors out there, Minds Capital's proclivity towards working with first-time sponsors and searchers is probably among the highest. This is the world we're coming from. We know it well. We constantly look at deals from first-time sponsors. But for us, whose job it is now to deploy capital on behalf of our investors out of a fund, we want to maximize deal flow. And it's very simple. We see more deal flow from the universe of serial deal makers. And so naturally, a good chunk of our capital goes in that direction as well.
And just to double click a little bit more on this concept of serial acquirers, repeat independent sponsors, obviously sponsors who have a track record they have that going for them. That kind of just right out the gate makes them more desirable, at least on paper, having done this before and demonstrated returns and so on. First-time sponsors, on the other hand, don't have that, but they can have all these other sort of interesting advantages. It's something that we've been talking about offline. Nicholas, say more about how you think about first-time sponsors and the opportunities that might live in that group.
For a first-time sponsor, when they come to us with a deal under LOI, that deal can have been sourced from a range of different places. It can have been a pretty conventional search, but it could also be that the deal came through them in a unique way, where they were working in a small company, and then all of a sudden the owner said, I want to sell, and they were able to somehow get it under LOI, and it's an MBO, and a management buyout. Or another example could be that they have very deep industry expertise. We recently invested in a deal in the eyewear industry where the two sponsors had spent 20, 30 years within this industry. And so, yes, it's their first deal on a solo basis, but their industry network experience just is unparalleled. And so when they came with a deal, it's a no-brainer, even though they don't have the track record as sponsors, because they have such a clear value creation plan. They have operational experience and experience growing companies in the industry from before. I would also point out that first-time sponsors are very, very hungry. This is not just another deal with another set of fees that they can kind of camouflage in a broader portfolio. Not that I necessarily see sponsors try to just do deals for deal's sake, but there is a reputation out there that it happens. With a first-time sponsor, you can't afford that. If your first deal goes awry, it can really turn your career upside down. So getting that first deal right, or at least not wrong, is crucial for their life and therefore for their career. So they come into it with a little bit of a different risk profile as well. So track record matters, especially when you know the sponsor. It's more comfortable to go with them again when they bring us new deals. But as I tried to say, Minds Capital, we understand searchers. I've been one. Max does QFEs for them. And will you interrogate them for a living? We understand searchers. We respect and appreciate searchers. And so we are looking forward to continuing to look at these deals.
And there's also another version, perfect segue there, Nicholas, because there's another version of the first-time sponsor, which is the searcher that became a sponsor because they found mid-search, because they found a deal that was too large to be a search deal, an SBA style deal. Jan Winiarski, of course, is Exhibit A. His story recently aired on Acquiring Minds. He's come and talked to our LPs. He was a self-funded searcher, and the deal that he found that he fell in love with, which he thought was $1 million of SDE, ended up being almost $4 million of EBITDA. And so he initially was very disappointed because he thought it meant he was going to have to walk from the deal. Of course, an SBA is not going to be able to take that down. But he had a call with you, Nicholas. This is all covered in his episode. And you showed him a path to acquire the business as an independent sponsor, how everything changes, the structure, the economics. So, I mean, it was a pretty big pivot in his approach to how he would do this. But he did execute it and has subsequently become very enthusiastic about the entire independent sponsor model. Jan is a perfect example of that. There are others, but I think that's another kind of profile of first-time sponsor, and one that can have a lot going for it. The hunger, in particular, as you said, Nicholas.
Yeah, it's for me. Going into this, I'm obviously super conservative in terms of investing and due diligence. So a track record for me always seemed like the most logical, most investable sponsor. And I think to some extent, obviously it still is. And, if we get a call or a deal from a sponsor that has had lots of success in the past, of course, we're going to look at that deal and there's a decent chance we may invest in that deal, right? But I think the learning for me has been what you said, Nicholas and Will, that there are these other factors that come into play with these first-time sponsors that make the deal sometimes extremely interesting. And so I think it requires a little more diligence on the sponsor in that instance. But I've been at least really excited about these deals where it has been a first-time sponsor. And I think, in some cases it's manifested as a favorable valuation, or it's just manifested as, like you said, a really hungry sponsor that has found a really good alignment with their skill set.
Yeah. Or the industry insider profile can be just a killer. Yeah.
Super valuable. Yeah.
Just looking at our portfolio, the 13 deals that have closed to date, 5 of those deals were with first-time sponsors.
Well, guys, let's talk more about how we evaluate deals. We go through the process, of course, of talking to the sponsors and reviewing the SIM deeply. Max, we have your financial diligence. We have, having a GP that is a financial due diligence provider is an incredible ace in our pocket. But we also have this evaluation process, this form that each of us fills out that is very granular about kind of every possible angle of the deal, sponsor, industry, market. Nicholas, this was your brainchild. Talk to us a little bit more about it.
Yeah, if you go back 1 year in time when we had just launched Fund 1, I recall this time last year, I was really obsessed with getting our operations nailed down and becoming as efficient as we can. And so the way that's turned out for us is that I typically do a lot of the deal screening, and then I loop the two of you in. And for any deal that we commit to, we always have unanimous approval. And I would say my time is spent broadly because I look at everything we look at, and of course spend more time the deeper in the diligence we do. But especially Max will be kind of the final due diligence layer for us and do the deep dive and kind of recalibrate or redo the model on our side and stuff like that. So we feel really good about our process. In terms of what we look for, first we look for red flags. And so we have this survey that we use online. All 3 of us submitted for any deal that we look at. It has about, 80 or 90 questions. The questions are structured into 4 sections. So we look at the market, we look at the target company, we look at the sponsor, and we look at the deal terms. And the deal terms includes both the terms from the seller to the buyer and from the GP to us as LPs. And then we go through this flag analysis and 80 or 90 checklist items, and that will uncover whether there are any kind of things that are not palatable at all. It'll also uncover if there are aspects that are particularly exciting, such as market leadership or sponsor target fit or strong differentiation in the target. And so this then gives us a really good foundation for having a more serious discussion about a target. And then I think when we then kind of convert the discussion from, okay, we've kind of cleared the downside, seems like a stable target in an industry without headwinds, the terms seem okay, the sponsor is with it. We start to look at the upside. And I would say on the upside, we get very excited about differentiated targets. We get very excited about good sponsor target fits. And then I get very excited when a base case is based on a continuation of what's already happened, meaning we're going to sell it for the same multiple as we're buying it for. The revenue growth it's going to continue more or less at the same pace we've had it. The margin is going to be what we've had it, right? The more you see, we're going to change management, we're going to have a multiple arbitrage, we're going to do a lot of M&A in order to reach our exit, we're going to expand margin, and we're going to double revenue growth. Like, this is all fine, especially if you have a track record or specific industry experience, but it just means there is more to believe in. So a base case where there is, so to speak, less to believe in is just easier to fathom and get your arms around. So I think once it's gone through all of these layers, we ask ourselves at the very end, if we're going to commit to one deal this month, is this the one? And this is not a hard mandate. We have committed to several deals just in the last week, but we've also had months where we don't do any deals at all. And I think we agreed up front that will be roughly our cadence, at least as we get going with Minds Capital. And it provides kind of a very interesting third layer, because first we look at the downside, then we look at, do we believe in the upside? And thirdly, okay, it's good enough, right? But is it the best deal that we have in the pipeline right now? So I like how we inject that into the conversation at the very end before approving a deal. Just one more point on this is we have a survey. It's like a Google form that we created for all of this. And it is our intention to make that public at one point. I don't know if anyone would actually use it, but we like to be transparent, and we have found it to be a useful tool. And if people actually use it, it would be amazing for data gathering for us. So one day we'll get there. We'll get it up on our website one day.
One thing you said there, Nicholas, about our evaluation process was how a grand plan is actually pretty unappealing if there's all of these things that need to happen. At each one of those is a potential link in the chain that could break. On the other hand, we also really like to see a deal or a business that has 10 levers that could be pulled. The more levers that could be pulled, where each lever individually could add value, the better. And so we'll see. So the kind of the sweet, or the ideal, is a business that if it just does more of the same, if it just keeps going according to how it's performed in the, historically, it's a win. But if then on top of that, there's 5, 6, 7, and 8 things that are possible ways to add value, they don't have to work together. They don't all have to work, connect, but just each individual one could be a lever. It becomes extremely enticing and a powerful sell. On deal flow, we've talked about it a couple of times. Nicholas, say again, our goal was committing to a deal a month, so a monthly cadence. Tie that into operations, because a lot of people, when we tell that we're investing in a deal a month, they're surprised that we can do that sort of volume. So say more about that for anybody who might be confused at the volume. How are we pulling that off?
Look, we're a minority investor, and as I always say, I don't really care if we own 1% or 21%, but it's not our concept to own 51%. That's why we partner with sponsors. We want them to lead the management and executive role of the company, and then we're along for the ride. We want quarterly updates. If we can help, by all means, we're here. We have experience. We are resourceful. But in general, we partner with very talented sponsors who are bringing these deals from there and onwards. That also means we don't necessarily, or usually we don't take board seats. We are, as you would say, more of a passive investor. So this means that our work really is on the front end of deals. And so then if you're an investor into us, we're not adding value. We're not adding the value post-closing necessarily. That means we have to add value to our investors pre-closing. And so what is the one big way we can do that? It's deal flow. Most of our investors are not full-time investors, or this is not what they do as a full-time thing, to invest in lower middle market deals. So they think it's a cool asset class. They believe in it as a long-term, liquid, but growth investment. And they think that we can generate a good portfolio because we have good deal flow. And we obsess over deal flow. Initially, this was all started because we thought Max, who does 100 QFEs for sponsors every year through his firm, that alone was good deal flow. And then Will, you were brought in with your reach through Acquiring Minds and now through the Minds Capital podcast. That gives us deal flow. I've been a sponsor for a long time. I know people in this ecosystem. So through our general network, we generate deal flow. And as I said earlier in the episode, the more deal flow we can generate, the more we have to look at. And the more we have to look at, the more we learn. And also, crucially, the more selective we can be. And therein lies our opportunity to generate a good return on a risk-adjusted diversified portfolio.
And we're seeing about one deal per day.
Yep, I would say that's about where we're at right now. And that includes, for the most part, good, relevant deals. We are seeing our deal flow grow every month as well, which is to be expected since we're a relatively new fund. But we know that if we continue to obsess over deal flow, everything else that we want to get out of Minds Capital will come downstream from that. And as long as we have the deal flow, that's really, really valuable. I was speaking to another prolific investor in the lower middle market the other day. It's one of the big SBIC funds. Everyone who's in this market will know who it is. It was just a few days ago. And he said that they've had about 100 exits on the equity side. They're mostly debt, but on the equity side, about 100 exits. And he said they have netted north of 3x MOIC on their equity investments in this space. So this is just terrific. It's super exciting from my vantage point. If you're in a space and you can do this in a portfolio manner over time and believe that you're going to be in the ballpark of 3x MOIC, there is really no limit to how much you want to invest in an asset that can generate that kind of return. So we're early stage still. We haven't proven it out directly, but it's very encouraging to hear data points like that.
Absolutely. One thing on the deal flow that we've had to get used to, though, is that there's some seasonality to deal flow. Max knows this well and always reassures us when it feels like the deal flow has gone down to a trickle, that it'll come back, and like clockwork, it does. So it's kind of a when it rains, it pours sort of situation that we've had to get used to. But it averages out to something like a deal a day around there.
You said when it rains, it pours, that it's seasonal. And I think after 10 years of doing QVs in this space, I think I've sort of figured out what the season looks like. And so the first quarter could be a little slow because sellers are filing taxes and doing financial reporting and compliance. Also buyers and sponsors are doing the same. They're doing taxes and they're putting together financial results for their investors. So particularly in January, February, it could be slow. Then tax season starts rolling around right after that. So that can slow things down just a bit. And then it starts to pick up. And then as soon as the kids get out of school for the summer, a lot of these folks are, independent sponsors that have flexible schedules and they have some means to travel with their families. So in the summer, they'll travel, and so things can slow down just a bit in the summer. And then you better buckle up because as soon as summer's over, all those type A, highly motivated sponsors and participants in this space get extremely active and try to make up for lost time for the vacation in the summer. And so they start really moving fast in the third and fourth quarters. So I think we see spikes really. I think we're just starting to see the spike at the end of the summer, and moving in towards the latter part of the year. Folks like to close deals before year end. They like to get the capital deployed. They like to start the year off fresh with a nice clean new accounting file for the new company, and so last quarter tends to be the busiest. So I think it will always come in waves, and if the cadence is a deal a month, it might, like you said, Nicholas, it might be 3 deals in 1 month and 0 the next, and 4 or 5 the next. So it's going to be lumpy, but the deals are there. And as long as there's no macro, big problem or liquidity problem, and if debt's getting locked up, if something really is is hurting the economy, that will change and the market will slow down. But as long as the macro is good, there's a lot of capital out there. There's a lot of assets out there ultimately that are going to need to trade.
Nicholas, we'd been speaking offline a little bit about the macro environment, and which you've been kind of studying for the last few weeks. Share with the audience what you were sharing with us, please.
Yeah, thank you for teeing that up. Last week we learned, so we're now August 4th today. Last week we learned that Q2 growth was a little slower than anticipated. The markets reacted negatively. We also learned on Friday that the July jobs report was pretty weak. After a 3-month rally in the stock markets, people are questioning whether stocks can go that much higher given the current PE ratios. I think I interpret this as noise, to be honest. We saw deal flow drop a little bit in the aftermath of April when you had Liberation Day and there was noise because of the tariffs. But the public markets that react the fastest of everyone, they quickly figured that out, hence the rally in May and June and July. And then in the lower middle market, I think we saw deals pick up again after, I would say from mid-June and onwards, we've had very good deal flow. And I actually take a fairly bullish or a very bullish perspective on the US economy or in equities is a good place to invest. So let me flesh that out a little bit because I think there are at least 5 things that come to mind. The first thing is the recent tax bill incentivizes companies to invest more in CapEx because depreciation is accelerated. And you're going to see both small companies and large companies invest more in new plants and new production facilities because they can write it off against taxes sooner. And CapEx investments, that's a real growth driver in the economy. And CapEx is exacerbated further by the need for data centers. AI is transformative. We all agree on that. The need for data centers is just never ending. And all of this is massive CapEx going into the economy. Again, a growth driver. Everything I've seen that even touches AI or data centers, like steel fabricators and machine shops I've come across, if they can say that, oh, we're servicing new data centers, there are multiple doubles. It's been insane. So those 2 factors, AI CapEx and the tax bill CapEx for me are positive long-term growth factors. Thirdly, AI in itself is transformative. This will greatly enhance productivity in every industry, and the US is leading the charge. This is where you'll see the fastest productivity gains, and relative to other countries, that means our economy and the companies in the United States are going to become more competitive because they have a faster growth in productivity. And if you're more competitive, of course, this will continue to generate growth. Fourthly, the tariffs. I'm an economics guy. I'm all about free trade. I understand that fair open trade where there are no tariffs is going to be more efficient for the global economy. I don't really want to dig into the political argument here now, but the fact is the US has imposed tariffs, and the result of that will be that companies are incentivized to move their productions and operations to the United States. So if you're a foreign company right now and you're trying to overcome the 15% tariff that has just been slammed on you, well, part of the solution, at least for your participation in the US market, is to move to the United States. Again, investment into our economy. And if you're a company already based in the United States, you've now become more competitive overnight because your foreign competitors are slammed with a 15% cost increase. So this is positive for US companies, at least in the short and medium terms. People will say that tariffs can be inflationary. I don't think we've seen the empirical data on that yet. We also have to remember that 85% of the economy is services, which isn't really affected by tariffs in the same way as products and goods are. So I don't think the impact will be that great of tariffs on inflation, but it can be quite big on competitiveness. And then lastly, I would say DOGE has been a little disappointing overall. And the tax bill The judgment is still out on whether they should have cut more costs, right? But we do know that there are 2 reconciliation bills in the works in Congress right now where they're aiming to shave more costs. We do know that DOGE has at least had marginal impact on the deficit situation. And I think it is positive for the economy if the fiscal situation of the government becomes more sustainable over time. They're saying and claiming that all of this should put us on a pathway to break even in 5 years. I don't know if I believe in that, but relatively speaking to many other countries, there is a focus now on fiscal responsibility, and I think that will serve the economy better in the long term. So for all of these reasons, I am long equities. And if you think PE ratios are too high in the public markets, then the lower middle market and private equity happens to be a fantastic place to play.
Interesting that you mentioned the cash savings for the corporations related to the tax bill, because there's an article, Nicholas, today in the Wall Street Journal about exactly that. And it just happens to have some metrics here related to exactly what you were talking about. So because of the tax change, the permanent upfront expensing, the permanent upfront depreciation on capital assets, Alphabet, or at least the Wall Street Journal suggests that Alphabet will save or have additional cash flow of almost $18 billion this year. Amazon will have additional cash flow of almost $16 billion this year. 12.45 billion for Microsoft and 11 billion for Meta. That's obviously just those magnificent tech companies, but obviously we've got lots of other industrial companies that are going to benefit from that as well. So that's just a ton of cash that's going to be available for investment or reinvestment into the economy. I think it's going to make a very positive impact on the economy this year.
Nicholas, you mentioned the Minds Capital podcast a few minutes ago, which, of course, if you're hearing this, you probably already know what it is because you are a listener. But just for a little bit of background and then to share with you, listener, where we are with 25 episodes into this project. We started the Minds Capital podcast for a few reasons. We wanted to provide value to the ecosystem. So in the form of education, showing key learnings and lessons from sponsors who are in the trenches doing deals right now, surfacing all of those stories and all of those learnings for the benefit of everybody else. There didn't seem to be something like it. There are definitely a few podcasts out there. They didn't seem to be publishing with the consistency that we envisioned doing. We had a model to lean on in Acquiring Minds, so we knew we could build a content production engine where we could regularly recruit guests and regularly put them out. And really, the goal was to establish ourselves as the authoritative voice in our ecosystem of independent sponsorship. We are, of course, learning at an accelerated rate ourselves by all of these conversations. So we want to become smarter as fast as we can as investors into this asset class. And so this is another way of doing that. And of course, we wanted to elevate the Minds Capital brand across the ecosystem. And so this is content marketing, traditional content marketing for Minds Capital. So it has gone extremely well. I actually have a benchmark here of my other podcast, Acquiring Minds. So we launched the podcast in mid-February. And by about mid-June, so I'm looking at numbers of about a month and a half ago, we were at about 1,500 listeners per episode. Just to compare to Acquiring Minds, it took 9 months, so more than twice the amount of time for Acquiring Minds to reach the same listenership that we have here with the Minds Capital podcast. So by that measure, it's going very, very well. And arguably in a smaller universe or a harder to reach audience, because in the independent sponsor universe are not people necessarily like Acquiring Minds. Acquiring Minds was benefiting from some trends like the boring business trend. Of course, entrepreneurship through acquisition as a trend has exploded. So there were tailwinds that Acquiring Minds could benefit from and contributed to, I'd like to think. But Minds Capital doesn't doesn't quite have that as much, which makes, I think, the progress that we've seen in growth of the audience all the more impressive.
I keep saying that nobody's learning more from it than me. It's just been a phenomenal journey, and the caliber of the people we interview and the people we get to know through this podcast is just sky high. I think it compares well to any other business setting or industry. Super stimulating and inspiring. And this caliber, by the way, it's not an outlier compared to the people we work with when it comes to deal flow on a daily basis. It's representative of who's in this ecosystem. So altogether, just super motivational and excited to keep going.
Well, guys, let's talk a little bit about things that could have gone better. We closed fund one a little too soon. Nicholas, you were closest to the fundraising process. Expand on that, please.
Right. Yeah. So our first fund, we all have day jobs, or at least we did at the time. And so this was a side gig for us. We just thought we could generate deal flow from what we're already doing. And we raised some money from people in our relatively close network and closed down the fund, and then went public with it. And we had an episode on acquiring minds. We got a lot of inbounds because of that episode, and we decided not to reopen fundraising, but we could have. And the argument was that we had promised one thing to the investors, and we had kind of met that goal, and we were worried that we weren't going to be able to deploy it. But what we have seen is that we could have easily deployed more capital into every deal we've done so far. And it would have increased our stake from, not 1%, but not quite to 21% either. My point is just we would have still been a minority investor. So we could have raised a little bit more funds for Fund 1, but strategically it wouldn't have made a big difference. But for us as the GPs, it would have perhaps given us a little bit more leeway on the back end. And then our check size would have been bigger, so it could have helped generate even more deal flow.
Yeah, there's quite a bit of strategy, as it turns out, in fundraising from LPs. How much to raise, from whom, when to open, when to close. Second thing that we have learned the hard way in a couple of cases is we've lost a few deals right at the commitment stage because we didn't act fast enough. Say more, please.
It's a lot of work to diligence these deals, and we're obviously trying to make the best decisions that we can. And we're trying to do as much diligence as we can in a relatively short amount of time because these deals move very quickly. The best deals don't have much trouble raising capital. And, we're a small equity check with Fund 1. So that means that we really have to move fast, particularly if it's a really strong deal. And I think I know there have been a couple deals where we simply just didn't move fast enough. And I think particularly early on, while we were still formalizing our diligence process and what to review, what to do as we evaluated these deals, we just weren't moving fast enough. And we had at least two deals that I recall where we gave a favorable decision to the sponsor, and it was just too late. There wasn't any room left. The deal moved on and closed, and it just tells us that we have to move faster. And it's exciting that it's been really successful and that our deal flow has been really strong. But it also means that we need to spend as much time on it as we can, and we need to do our diligence. We don't need to shortcut anything. We need to continue to be very responsible with our investments, but we need to be structured and we need to have a way to get to a quick decision. And we've discussed having some additional resources for Fund 2. Yeah. So I think, you have to, as you grow, you have to make some hires and you have to fill a few seats, particularly, analytical seats, to help evaluate these deals a bit faster.
Another thing about this, at least for Fund 1, when we were just starting and building our brand and building our Rolodex, is that positioned as we are as a gap equity check, a passive check, we're often plugging holes in the deals that we see. Not always, and that'll happen less as we see, sponsors come back to us that we're regularly working with, and we like to think that we'll be one of their early calls as they kick off their fundraising process. But that was not so in Fund 1. So many of the deals that we've invested in were already well along in their process by the time they hit our desk. So we were, in our defense, we don't want this to happen, but in our defense, we were a late phone call in their fundraising process, and that was part of the squeeze as well. But I'll just also say a philosophical point that one of the things, Nicholas, you've always said and kind of beaten the drum on is that we are a service provider. We see ourselves as a service provider to independent sponsors, not just capital deployers. And in the spirit of being excellent service providers, we want to be as responsive and as fast moving as possible. So when we lose a deal, we don't just feel disappointment because of a lost financial opportunity to deploy capital into something that we're excited about, but also a little bit of we've tripped up in the service delivery. We haven't been as responsive and as fast acting as we want to be for all of our quote clients, that is the independent sponsors.
In private, I've been really nice to you guys about these situations, but let me just publicly say it's been super annoying, and but we've learned from it, and we have gotten a lot better, and we continue to tweak our own process. And we're trying to be super respectful with everyone who is gracious enough to share their investment opportunities with us, to both give it a fair shake and to shake it as fast as we can, if that makes sense. And yeah.
I think the other thing with this, when you first start doing this, you want to uncover everything. You want to look at everything. You want to spend. You're investing other people's money, so we're being as careful as we can be with this. The more we do it, we get to know certain sponsors. We know more about the sponsor, and so there's less diligence to do on that sponsor. For example, if it's a repeat sponsor, but we've also. And if we have to make a quick decision, I think we've prioritized better what is truly important about the deal. Where do we need to dig the fastest right away? And I think one of those items is valuation and circumstance. So if it's a deal where the sponsor found it maybe not in a conventional process, but through a proprietary means, and they had some advantage in finding this deal, and they found it for a really great price. I mean, that's something that's very enticing right off the bat. And then if it's, in that situation, if it's a sponsor with a track record that we already know that sponsor, that's a good sign. I know we talked about some of the benefits of working with first-time sponsors, and obviously we're very open to that. But if it's a sponsor with a track record, if the valuation is really appealing, if it's an industry that we're already thinking about, if the Q of E has already been done, we know the documents that we need for underwriting now that we must have to make a quick decision. We have to have the Q of E. We have to have a financial model where starting EBITDA is supported by the Q of E. We have to have a strong SIM and investment presentation, and we have to have all of us have a call with that sponsor. If we can make those things happen, if we can receive those documents quickly, and some of those other characteristics of the deal are appealing, then we're better equipped to make a quick decision. I think at least in one of the deals that fell through, we perhaps didn't have all the necessary underwriting documents right up front. Perhaps we were missing the Q of E, and then, got it a few days later or something like that. So I think we've gotten better at identifying and communicating with the sponsor, who is basically our client, up front, getting the data that we need to make a quick decision. I think we're much more primed now to make quick decisions than we were when we started.
Yeah.
To summarize really quickly there are three main things that we always look for, right? It's the investment memo put together by the sponsor to explain the thesis and the deal. It's the Q of E, and it's the pro forma model. Those are the three that I at least always ask for. And then we want to have meetings with them to get to know them and hear it from the horse's mouth.
Yeah. And when they have all those things, if it's a great deal that's moving quickly, those things are usually available immediately because other folks have already committed to the deal. And I think these deals that tend to move slower, they're waiting on the QV, or the QV often, what we've seen happen several times, the QV comes back and it doesn't support the financial model. So they're reworking the financial model. They may be retrading the deal. There's things that naturally happen in these deals that can slow the deal down. If that deal gets retraded, oftentimes if we like the deal and like everything other than the fact that we think the valuation was high, that deal can come back around and we can still do it. But where those three documents have been provided, where the QOV supports the numbers, where there's already other capital providers that have committed to the deal, you've got to move fast, or the deal will unfortunately move along without you.
Guys, let's wrap with a discussion of what is coming, which of course is Fund 2. We have talked, we've mentioned it, we've implied it. So let's talk to it explicitly. I'll start actually with one of the negatives, if you will, is as we contemplated how large we should go and how many LPs we should target, we bumped up against an SEC regulation. Max, what was that?
Yeah, well, we are not an investment company. We're not a registered investment company with the SEC. And to be a registered investment company is a massive undertaking. It's for much, much larger enterprises. And so under the SEC, we're able to raise capital for private investments, but we are only allowed to have 99 investors per fund. So whereas we have taken more of a retail approach to raising capital, which we're still doing, well, there's not an unlimited amount of investors that we can have. We're capped at 99, so we have to stick to that for each fund.
And our ticket to participate as an LP in Fund 1 was $100,000. And so you can do the math that if $100,000 times 99 investors is $10 million, under $10 million. And we think we could have deployed well north of $10 million, even in Fund 1, let alone the momentum that we have going into Fund 2. Which leads to solving for that problem, you increase the check size minimums for LPs to participate. Nicholas, say more about what our thinking is at this point.
Well, that was our minimum check size for Fund 1. Our average was somewhat higher because we had some bigger investors in there as well, of course. But for Fund 2, for new investors, our thinking is that the minimum ticket will be $200,000 for new investors coming into that fund.
Great. And for Fund 2, the types of deals and targets that we'll be looking at are going to be exactly the same. However, our own check size into each deal will grow. Nicholas, what is the strategy on that, please?
Yeah, that's right. We're going to be investing in exactly the same deals. We're just going to be deploying more into them. And so we'll do 10 deals in Fund 2 with $1 to $3 million of equity into each deal. And some of that may be saved for add-on acquisitions and so forth. So I imagine that the initial platform investment will be somewhere in the $1 million, and with some dry powder for later on in the fund life. But that's the thinking for Fund 2, Flagship 2, as we're calling it.
And timing?
We should be, so we think we'll be finished deploying Fund 1 here sometime this fall, Halloween, Thanksgiving, something like that. And our deal flow isn't going to stop, so we'll hopefully roll straight into Fund 2 after that. We'll actively start fundraising soon.
And we're going to be launching webinars, sort of an office hours style ability for interested prospective LPs, accredited investors, of course, to come learn more about the opportunity, ask questions of us directly. So we're excited about the sort of process we're going to put in place to help educate people as to what it looks like to invest in a fund that's so active in the lower middle market.
What we have discovered is that our reach on LinkedIn and with our podcasts does not only generate deal flow, it also happens to connect us with people with capital and investors. So we are in a very lucky position to get inbounds when it comes to investor interest, and they can find their way to our website and connect with us that way.
We have an investor registration form at mindscapital.co. So for all of you accredited investors listening, go to mindscapital.co and you'll find the form there. To close out here, let's also talk about the other thing that we're excited about that we have planned for the fall, the Minds Capital Offsite that we are doing adjacent to the McGuire Woods big fall independent sponsor conference happening in October. Nicholas, tell us more about what the Minds Offsite will include.
Yeah, it's a gathering exclusively for our own investors and for our portfolio sponsors. And it's going to be an annual thing. We're doing it the day after the McGuire Woods conference in Dallas because we know a lot of the folks will be in town for that event. And the program will consist of visiting one of our portfolio companies, Quiltcraft. It was an award-winning deal, Willistown Capital out of Texas. So we'll be doing a tour of their facilities in the morning. We'll be doing networking over lunch. And then in the afternoon, we're meeting at our bank and where we have kind of their conference room area to have a series of panels. And we will be we already have started this, inviting speakers to come there. It's going to be a fairly small group, 2, 3, 4 dozen people, but an important group for us. And they're going to get hopefully a good show for the day. And we will hopefully learn a lot. So some of the sessions that we are thinking about is, why do small private equity deals outperform? A market sizing exercise of the independent sponsor world. We'll talk with one who's talking about the evolution and future of independent sponsor land, look at some of the terms from recent studies. And then we'll talk, of course, about Minds Capital as well, some version of this episode we're recording right here, right now.
And what is the exact date for that, please?
Thursday, October 16. You're coming, right?
I'll be there. It's on my calendar. It's just not recorded in memory. Great, guys. Well, thank you for doing this behind the scenes at Minds Capital. It has been an honor working with the both of you these last 2 years as we have built it. I'm thrilled for Fund 2 and everything we have in store there. And thank you all for listening to the Minds Capital podcast. We'll have episode 26 and another interview for you next week, as always. Hope you enjoyed that interview. For more like it, subscribe to Meeting of the Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraises. See you in the next episode.